All right, let's dive in. Today, we're going to break down one of the most powerful tools in all of finance, a method for figuring out what a company is actually worth. I mean, this is the big one, isn't it? The billion-dollar question. When you look at a company's stock price, what are you really seeing? Is that its deep down intrinsic value, or is it just, the market's mood of the day? How do we cut through all that noise to find a solid number? Okay, but before we jump into the mechanics, let's get one thing straight. Valuing a company isn't like a math problem with one perfect answer, not even for the pros. It's a complex game. Think of it less like finding a precise, guaranteed value and more like making a really, really educated anticipation of the future. So, how do we calculate that anticipation? Well, the main tool for the job, the method we're exploring today, is called discounted cash flow. You'll hear it called DCF. And it's all about figuring out what a company's future is worth right now in today's money. At its heart, the idea behind DCF is pretty simple. It says a company is worth the sum of all the cash it's ever going to generate. But, and this is the crucial twist, you can't just add it all up. You have to discount that future money to figure out what it's worth to us today. Now, to really wrap your head around DCF, we first have to understand the one core principle that makes this whole thing work. It's like the engine under the hood. It's called the time value of money. This concept is huge, but it's also super intuitive. All it really says is that $100 in your pocket right now is more valuable than the promise of $100 a year from now. Why? Well, because you could invest the money you have now, and there's also something called opportunity cost. Basically, you can do something with that money right now. Let's make this crystal clear. Imagine someone offers you a choice. You can have 100,000 rupees today, right now, or you can get the exact same amount, but you have to wait a whole year. It's a no-brainer, right? You take the money now because you can put it to work. And here is precisely why that's the smart move. If you take that 100,000 today and just pop it into a simple investment that earns 5% a year, well, in 1 year, it's become 105,000 rupees. That's 5,000 more than the other option. That difference, that's the time value of money in action. And it's the entire logic behind discounting future cash. Okay, so we've established that money today is worth more than money tomorrow. With that in our back pocket, we can start to actually build our valuation. And a good DCF model is built on 3 main pillars. Here's what they are. First, you've got to forecast the company's future cash flows. Second, you have to pick a discount rate to bring all those future numbers back to the present. And third, you need an estimate for the company's value way out in the future, beyond your initial forecast. So let's talk about that first pillar. We're not interested in profit, which can be kind of fuzzy with accounting rules. We want free cash flow. This is the actual, hard cash a company has left after it pays for all its operations and invests in its own growth. It's the real deal. Pillar number 2, the discount rate, is so important. This is the rate we use to shrink those future cash flows into today's value. It has to reflect both that opportunity cost we talked about and how risky the company is. And the bottom line is simple. The riskier the company, the higher the discount rate we're going to use. And finally, we have terminal value. Look, you can't forecast cash flows year by year forever, so analysts usually project out for, say, 5 or 10 years. The terminal value is an estimate of the company's entire worth from that point forward, all rolled up into one single number. Now, we have our 3 pillars, but before we put them all together, there is one absolutely non-negotiable golden rule you have to follow. This is what separates a good analysis from a bad one. So to get this rule, you just need to know there are 2 main flavors of free cash flow. There's free cash flow to equity, the cash available only to shareholders. And then there's free cash flow to the firm, the cash available to both shareholders and lenders. The key is that each of these has to be paired with its own specific discount rate. This is so fundamental, it's actually called the first principle of valuation. Get this right, and you're on your way. Get it wrong, and your entire valuation is basically worthless. And there it is. You absolutely cannot mix and match these pairs. It's like apples and oranges. If you're using cash flow that belongs just to equity holders, you have to use the discount rate that they require. If you use cash flow for the whole firm, you have to use a discount rate that reflects the cost for the whole firm. Mismatch these, and you'll get a completely wrong answer. So we have our 3 pillars, and we know the golden rule. How does this all come together to give us that final number? Let's put all the pieces in place. The process really boils down to this. First, you forecast the free cash flows for the next several years. Second, you select the correct discount rate, remembering not to mix and match. Third, you calculate the terminal value for the long haul. And finally, you use that discount rate to bring all those future numbers back to the present day and add them all up. That final sum, that's your company's intrinsic value. And that's really the core logic. While the actual process involves tons of assumptions, the idea itself is beautifully simple. By understanding these pillars and the golden rule, you now get how analysts try to find the true value that's hidden inside a company. So, I'll leave you with this question. Now that you understand the framework for valuing a business based on its future potential, think about the companies you follow. Does their current market price seem to reflect that future? Or is there a story the numbers aren't quite telling yet?